Greetings and welcome back to the lesson. We continue today with the subject Advanced Financial Management. The topic is mergers and acquisitions. We have been in the previous sessions studying various methods that may be used to value a target for mergers and acquisition purposes. Today we move to the next method or model, which is the capital asset pricing model. Capital asset pricing model. And candidates, it's important to note that the CAPM is not a standalone valuation method for mergers and acquisitions in the same way that discounted cash flow or market multiples are. CAPM in your syllabus has been listed as one of the models that can be used in valuation of mergers and acquisitions. But I'm saying that CAPM is not a standalone valuation model. Why? Because it is just a critical component that is used to calculate the cost of equity, which in turn is a key input for other widely used valuation models like the discounted cash flow method or the dividend discount model. So it is a model that we use in just adjusting the cost of equity, which is a critical component in the other methods that we use in valuing mergers and acquisitions. You understand? And CAPM describes the relationship between the expected return on an investment and its systematic risk, also known as non-diversifiable risk. CAPM provides a framework for determining the required rate of return for equity holders. And the formula candidates for the cost of equity of a firm using CAPM is cost of equity is equal to the risk-free rate plus beta times the premium. Return on the market minus risk-free rate. That is the formula for calculating the cost of equity using the CAPM model, where KE is the cost of equity or the expected return on equity. RF is the risk-free rate, typically the yield on a long-term government bond in the relevant currency. It could be a 10-year treasury bond and so on. Then this is the beta or beta. It is a measure of an investment's systematic risk, indicating how much its price is expected to move in relation to the overall market. That is beta. RM is the return on the market return. So when you deduct the risk-free rate from RM, you get the premium, what we call the market risk premium or equity risk premium. And this is the additional return investors expect for investing in the overall market. Because you see, this is the risk-free rate. So when you deduct the risk-free rate from the market return, you get what we call the premium. You understand? So that is capital asset pricing model formula. Now, we need to answer the question, how is it then used in mergers and acquisition valuation? How it is used? I know you are not studying CAPM for the first time. This one we covered it in other topics in detail. So how is CAPM used in mergers and acquisitions? CAPM. Now CAPM's primary role in mergers and acquisition valuation is in calculating the weighted average cost of capital. The primary role is primary role of CAPM in mergers and acquisition valuation is in calculating the weighted average cost of capital. The primary role of CAPM in mergers and acquisition valuation is in calculating the weighted average cost of capital, which is the discount rate used in discounted cash flow method. It may also be used in other methods. You understand? So the first application of CAPM candidates is in calculating the cost of equity. It is used in calculating the cost of equity as stated in our introductory statement here. It is used in calculating the cost of equity, KE, for the target company. KE for the target company. Do you understand? Yes. Calculating the cost of equity for the target company. And we've said that you have to determine the risk. In calculating the cost of equity, you have to determine, first of all, the risk-free rate. Obtain the yield on long-term government bond from the country where the target company operates. And this rate represents the return an investor would earn with the virtually no risk. Then there is a market premium. The market return minus risk-free rate, that is the market premium. You estimate the estimated return of the overall market above the risk-free rate, which is usually based on historical data and future expectations or projections. So you determine the premium, equity risk premium. Then there is the beta, which is a measure of risk. Beta is in our case here, could be the most complex component for private target companies because they don't have publicly traded stocks to derive a beta from. But for public targets, we use the historical beta of the target company stock. For private targets, that requires estimating what we call a proxy beta. If you are valuing a publicly traded company, the data is available. You use the historical data for that company. But if it's a private company, that requires just estimating a proxy beta by identifying publicly traded comparable companies in the same industry. Then you calculate the levered beta for those public comparables. Then you do what we call unlevering. Unlevering the comparable betas to remove the effect of their debt. You understand? Then you do relevering, where the asset beta using the target company's projected or desired post-acquisition debt-to-equity ratio and also the tax rate. You understand, Candice? But we are not getting deeply into all that. We are only focusing on the capital asset pricing model. So step number one is to calculate the cost of equity. We are studying how CAPM is used in mergers and acquisition candidates, and we are saying that the primary role of a CAPM in mergers and acquisitions is in calculating the weighted average cost of capital. First of all, you calculate the cost of equity. To calculate the cost of equity, you need the risk-free rate, you need the beta, you need the market return to determine the cost of equity. You understand? And the only complex input here is beta, particularly when dealing with private companies. For public companies, it becomes easier because you only use the beta of the target company stocks. Then number two is calculating the weighted average cost of capital. Calculating the weighted average cost of capital. This is the weighted average cost of capital, which is an average rate of return a company expects to pay to all its capital providers, that is the equity holders, the bond holders, the preferred stockholders, and so on. So the weighted average cost of capital is the standard discount rate for free cash flow to firm. It is the standard discount rate. It is the standard discount rate. It is the standard discount rate for free cash flow to firm. Free cash flow to firm. It is the standard discount rate for free. It is the standard discount rate for the free cash flow to firm. 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 The weighted average cost of capital, I'm repeating, is the standard discount rate for free cash flow to firm. Free cash flow to firm in the DCF valuation. So then, candidates, if that is the case, then the weighted average cost of capital would then be equal to the weight times KE plus, because we are doing the weight, we are weighting, we get the proportion of equity multiplied by the cost of equity. Then we get the proportion of debt and then multiply by the cost of debt. You understand? Cost of equity and cost of debt. These are the weights. The weight of equity, the weight of debt. Then here, of course, because of debt, we deduct multiply by 1 minus T, where T is the corporation tax rate. So weighted average cost of capital is equal to KE, cost of equity, which is calculated using CAPM. You understand? Calculated using CAPM. So that is how to determine the weighted average cost of capital. Now in mergers and acquisition candidates, the weighted average cost of capital calculation might reflect the target company's current capital structure or the acquirer's capital structure or a pro forma capital structure for the combined equity after the acquisition. You understand? Yes. So that is the second step. When using CAPM in valuing targets in mergers and acquisitions. Step number 1, you calculate the cost of equity for the target company. Then step number 2, you calculate the weighted average cost of capital. And when calculating the cost of equity, you use the CAPM model. And you recall we did state that the capital asset pricing model is not a standalone valuation method for mergers and acquisitions. In the same way that the discounted cash flow or PE basis or market multiples are. Instead, the CAPM is just a critical component used in calculating the cost of equity. So that's why here, this cost of equity is calculated using the CAPM. So once the cost of equity has been determined and the weighted average cost of capital is also determined, then we move to the third stage, which is the discounting. You discount now the cash flows, discounting cash flows. Discounting cash flows in DCF valuation. In DCF valuation. In DCF valuation. Discounting, you discount the cash flows in the DCF. DCF analysis. In the DCF analysis. Once the weighted average cost of capital is calculated using the CAPM, It is then used to discount the projected free cash flows to firm. The projected free cash flows to firm. The projected free cash flows to firm. You understand? What is also discounted is the terminal value in the DCF model back to the present values. And the resulting present value is the enterprise value of the target company. I hope that is clear, candidates. Is that clear? CAPM, as used in mergers and acquisition, is just a tool that we use to calculate the cost of equity, which is then used to calculate the weighted cost of capital. After you've done the weighted average cost of capital, then you use the weighted average cost of capital to discount the cash flows in the DCF valuation or DCF analysis. All right? Yes. So what are the pros? What are the advantages of the CAPM? One is theoretical soundness. One advantage is in relation to theoretical soundness. CAPM is a widely accepted and theoretically robust model for linking risk and return. Number two, there is also the aspect of systematic risk. Systematic risk focus. It explicitly accounts for systematic risk or non-diversifiable risk, which is the only risk that investors are compensated for in an efficient market. And of course, the unsystematic risk, which is a company-specific risk, is assumed to be diversifiable. Three, the third advantage is in relation to the intuitive relationship. Intuitive relationship. It establishes a clear linear relationship between higher risk and higher required return. 4, widespread acceptance. It is widely accepted. Due to its simplicity and theoretical backing, CAPM is commonly used in corporate finance and investment banking for calculating the cost of equity. So these are 4 advantages. How about disadvantages? Cons. The first disadvantage or limitation of CAPM in mergers and acquisitions is in relation to the assumptions. Assumptions. CAPM relies on several strong, often unrealistic assumptions. For example, efficient markets. Another assumption is rational investors. Another assumption is access to risk-free borrowing or lending with also homogeneous expectations. Those assumptions are not realistic. There is also another challenge in relation to data estimation. Data estimation challenges. Data estimation challenges. For example, the beta estimation for private companies. Estimating a reliable beta for a private target company can be challenging and also involves several subjective judgments, like choosing comparable companies, relevering, unlevering, and so on. Another challenge in relation to estimation is the market risk premium, which is not directly observable and can be estimated based on historical averages or forward-looking methods, both of which have their own limitations and can lead to different values. Moving on to another estimation challenge is the risk-free rate. Because while government bonds yields are readily available, selecting the appropriate maturities and assuming it remains constant throughout the projection period can be problematic. So those are estimation challenges. Estimation challenges are in relation to the beta estimation, the market risk premium, and also risk-free rate. Limitation number 3, historical data limitations. Historical data limitations. Historical betas may not be indicative of future risk, especially if the target company's business model or market conditions are expected to change significantly post-acquisition. Limitation number 4, this model ignores other risk factors. Ignores other risk factors. It ignores other risk factors. CAPM only considers systematic risk. It does not account for other factors. CAPM does not account for other factors apart from the systematic risks that might influence expected returns. There are other factors that might influence expected returns, such as a company size, such as liquidity. We have factors specific to maybe financial distress risks and so on. That's why we might have multi-factor models like the farmer French or the 3-factor model, which attempt to address some of these limitations. 5, it is another disadvantage in relation to stand-alone. It is not a stand-alone model. The beta derived from comparable companies might represent the target's standalone risk. However, the acquirer might be concerned about the combined entity's risk profile or how the target's risk changes are once they are integrated. So there is the standalone versus synergistic risk. Let me say versus synergistic risk. The beta derived from comparable companies might represent the target's standalone risk. Because you recall the procedure here, which I stated how to arrive at the beta. You select few companies from the market similar to the target. Then you may do averages for historical data or other data. So the beta, which represents the targets, is only specific to that target. It represents the target's standalone risk. However, the acquirer might be concerned about combined entities risk profile or how the target's risk changes once it is integrated. 6, CAPM is not a direct valuation model for mergers and acquisition purposes. CAPM itself does not directly value a company. It's just a component used within other valuation frameworks like the discount cash flow valuation method. It is not a direct valuation model. So candidates, these are the advantages and disadvantages of the CAPM. We've described how it is used in valuation of firms for mergers and acquisition purposes. In closing, we need to indicate that in mergers and acquisitions, we want to re-emphasize that CAPM is indispensable for deriving the cost of equity. This model is important, is critical in arriving or deriving the cost of equity, which is a critical input for the weighted average cost of equity. For the weighted average cost of equity. So the weighted average cost of equity is then used as the discount rate. It is then, in step number 3 here, used as the discount rate in discounted cash flow method, which is often the primary valuation approach in complex mergers and acquisition deals. So while CAPM has theoretical strengths and widespread acceptance, as we stated in In advantage number 4, while it is widely accepted, it's important to note that its practical application in mergers and acquisitions requires careful estimation of its inputs, particularly beta for private companies, and an awareness of its underlying assumptions and limitations. We've listed 6 limitations. One key limitation is in relation to the assumptions, which are sometimes unrealistic. So it is typically used in conjunction with other valuation methods to provide a robust and well-supported valuation range of a target company for mergers and acquisition purposes. So thank you. I'll meet you in our next session where we continue to analyze other valuation models for mergers and acquisition. Bye.